Right now, Srinivasan HR, Managing Director and Vice Chairman at Tech Solutions on the phone line with us. Good to have you, Srinivasan. Just, on the question of the recent preferential issue to the promoter, about 250 crore rupee intake that happened, how are you going to utilize these funds?
So these funds are earmarked for acquisitions that we intend to do in the US. We have a few targets in the pipeline, and hopefully we'll be able to conclude something in the near future. So these funds are essentially for acquisitions.
Point taken. When you say near future, what exactly are we talking about?
See, acquisitions are something on which you don't give deadlines. It's not something that you can. There are several factors. So the intention is certainly to do it during the course of this financial year and maybe even the first half, but we can't be held accountable. Acquisitions have too many dynamics to take care of till the deal fructifies.
Point taken. What areas would these acquisitions be in?
This would primarily be in the clinical area in the United States.
Fair enough. Just to give us a sense, of course, we know life sciences continues to dominate your revenue share. What are the value adds that you're looking at in terms of growing your portfolio that would then add through these acquisitions?
Right. So if you look at the three broad buckets of life sciences, so pharma R&D, we're looking at clinical, regulatory, and safety. Traditionally, we've dominated the regulatory and safety portfolio. And over the last 2 years, we've built a very decent book of business in the clinical in EU and Asia on the back of the Akron Akinova acquisition. Clinical is a very large piece. In the US, currently, we don't have a strong foothold. So this acquisition is to bolster that and then enable us to build an aggressive business on top of it.
All right. Apart from US, which other market is big for you?
See, for us, currently it's the US, followed by EU and then Asia. But during the course of maybe the next financial year, which is FY19, we may have Asia actually becoming larger than Europe, because the growth traction in Asia and the order book build-up in Asia that we're seeing is pretty strong.
So, if I could push you a little further on that point, what's the breakup between US, EU and Asia, and how much of Asia's share do you expect to grow?
So currently the US business is about close to 80%, and so it's way dominant.
Right.
And Asia is at about 7-8%, and the balance is EU.
Right.
I'd expect that maybe that trend just gets reversed during the course of the following FY, where Asia becomes maybe 12 or 13% and EU 10, and the rest still continues to be the US.
Point taken. Point taken. What's the kind of traction that you've seen both in terms of client additions in these markets in this quarter, and what's the kind of expectation you have for FY19?
So first, I think our business is a very steady business, in the sense that we get 95% of our business is repeat business from the same set of customers. So they keep giving us more business. So we evaluate how our relationship with existing customers is strengthening, and that's our key business driver. If you talk of client additions, every quarter we've been adding about 6 or 7 clients, primarily in the small and medium pharma segment, which is a very interesting segment where there is a lot more R&D work that is happening. And that's why you see Asia order book also growing primarily on the back of the SME segment.
All right. One of the reasons why I asked that question is because if you look at the street's view of your company over a longer term, revenues, the top line has grown at an impressive pace, but margins haven't really grown. In fact, margins have gone down over a longer period of time, currently at around 9.5-10%. So most of that growth has come because of the growing top line over operational efficiencies. Will that be the strategy going forward from here? What is the kind of expectation on both the top line as well as on the margin front?
See, on the margin front, I think we are at the EBITDA level, we are between 19 and 20%, and it should continue there for the current financial year. Next year, maybe we can expect 100 basis points improvement over that. As the clinical business continues to dominate, the margins in a steady state would be in this range. If you said earlier the margins were higher, that was because we were predominantly only regulatory and safety, where the margin is higher, but the pie is smaller. So if you look at the total EBITDA growth, that's been pretty impressive. The second one I want to call out is that our dollar growth rate in the last year has been about 30%. If you look at the last 9 quarters, our life sciences business has grown at a compounded quarterly growth rate of over 9%. And with this growth rate, you need to have investments to keep that growth rate up. We can pause the investment and say the margin should go up, which is possible, but then you are leaving a lot of growth on the table. So current focus of the company is to very quickly become a $500 million in size, which we are aiming to do by 2021. And therefore, this investment in growth will continue and the margins will be around where it is.
And what are the kind of investments that you will be putting in?
So we are enhancing the number of locations that we have. And these locations are audit-ready locations where client or sponsor audits or regulatory audits can take place. We are investing in manpower ahead of demand. We've overhauled a lot of our sales operations. We are investing in delivery capacity. So there are some investments that are coming up front. So you have to context the growth and the margins with the investments that are taking place for it.
Taken. Just before we let you go, then highlight at least a couple of your key growth drivers. Then how are you set up for FY19?
So we would believe that the life sciences segment obviously will be the key growth driver. So in dollar terms, we are looking at an organic growth rate that is upwards of 22%. Having said that, I must say that this year we may be achieving a 30% dollar growth rate and a 25% rupee growth rate. Primarily, the growth will come from the US geography, followed by the Asia geography. In the segment, the driver of growth will be the clinical business, followed by the regulatory business.
Mr. Srinivasan, we'll leave it at that. Thanks so much for joining in and patiently
answering
all the questions. That is Take Solutions for you, targeting to become a $500 million company by 2021. We'll look to maintain margins at current level, possibly expect a 1% expansion in margins over the next 1 year or so. And the focus will be to continue to grow revenue. US, of course, is a key market for them, but also looking to increase the share of business from Asia. Currently, it stands at about 7 to 8%.